Hello, my fellow investors. In this video, we'll start crunching the numbers of Texas Roadhouse, and I'll also compare Texas Roadhouse to DRI, which is Darden Restaurants. They're very comparable to Texas Roadhouse because they have mainly casual dining. It's a big company and they have a few concepts, but it'll give us a good indication of the casual dining industry. So let's start here in 2002. So Texas Roadhouse IPO'd in 2004, and they started in 1993. So I have here the information from the 2004 annual reports going back to 2002. So as you can see, they start off in 2002, 226 million. All these numbers are in thousands. 279. As you can see, the revenue slowly but slowly it's growing very nicely. Now it's not a major growth. We'll just take you afterwards to all the compound annual growth of the entire 10 and 20 years. So basically the revenue from 10 years from 2012 to 2021 was compounding at 10%. And the 20 years from 2002 to 2021, it was compounding at 14.5%. That's the top line. And over here I put in revenue. That means only the company's revenue besides the royalty. And then the total revenue is the revenue from the company's sales and the royalties from the franchises. And it's the royalty in Texas Roadhouse is a very small number. It's not significant. They don't have a lot of franchises. They don't get a lot of royalties, and it's hardly any different. You see the total revenue is 10.6% and 14.4%, and the revenue of the company sales is 10.6 and 14.5. It's very, very similar. So this is the revenue and the royalty. Now, I added on in this spreadsheet the cost of food and the labor and the margins. So in restaurants, the huge amount of the expenses is the cost of food and the labor, and we can see by seeing Texas Roadhouse and a different company to see how much their margins are. So as we can see, the cost of food in Texas Roadhouse is 32%. And there's a famous rule in the food industry that the food cost shouldn't be more than 33%. And Texas Roadhouse is more or less over there the whole time throughout all the years. 32.7, 32.8, 34, a little bit higher, 35, 35, 35. They became a little better afterwards, but they're very high. I mean, they hardly ever go down below 32%, and that isn't the best sign. But on the other hand, we can see the labor margins are much better. And the reason why Texas Roadhouse food costs are so high is because they're cheaper than most steakhouses. And that's why their food cost is higher in margins than other companies. And we can see here the labor. That means how much they're paying for waitresses, and it's all restaurant labor. It's not the SG&A. That's another thing. And the margins on the labor are actually pretty good. You can see here 28%, 27%, 28%, 29%. And what's interesting is that their margins are lower, although they don't serve so much lunch. It's mainly dinner. And we can see actually over here the Texas Roadhouse concept of serving only dinner and doing one shift instead of a full day is actually helping them in their labor margins. You can see throughout the whole years it's 29. Over here in the last years it went up much more, but throughout almost all the years it was under 30 almost the whole time. Now if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much. Okay, now the fun fact about Texas Roadhouse is the marketing. So they hardly pay any money for advertisements. They take a royalty fee of 4% from their franchises and another 0.2% of the gross sales for marketing, for advertisement. And in their 10Ks, they say how much they paid for advertisements. You can see it's almost nothing. $2 million, $2.5 million, $2.8 million. It's almost nothing. If you take it in percentages of the gross sales, it's nothing. 0.0009, 0.008787. It's hardly anything. In the later years, the company's growing and growing. $21 million. That's what they paid for marketing and advertisements. And a company that has sales of $3.4 billion. The advertising for $21 million is nothing. And you could take also into consideration that a company that has a big marketing department, besides all what they're paying for the advertisements, they also need full of employees who run all the advertisements, to make the advertisements, to run it in social media. It's a huge department, and the second they're not advertising, you're cutting off tons of costs. And this shows how strong the Texas Roadhouse brand is, that they don't need to advertise. They're growing very, very nice without paying hardly any advertisements. So there is an agreement with the franchises that they have to pay a small part of the sales for local advertising. So these numbers, the $21 million, or $13 million, or $18 million, $17 million, that's what the Texas Roadhouse corporate is paying for advertisements. So besides that, the local franchises do pay for their own advertisements. And so let's take the gross margins, which is the total sales minus the labor and food cost. So it's before SG&A. So in the first years, they were much better. And throughout the years, the gross margins actually became worse and worse. So we see over here 41, 42, 40, 40, 39, 38, 37, 38, 39. It's actually getting worse and worse throughout the years, the gross margins of the operations. Over here in 2020, it was 31%, 35%, 36%. And this is something very interesting. Although their margins are lower than let's say, DRI, which I'll show you soon, their net revenue is actually pretty good, and the net margins also not lagging so much after DRI. And another great thing about Texas Roadhouse is their expenses on SG&A. So what I did over here was I did a ratio of SG&A to sales. So besides doing the return on the SG&A, I did a ratio of SG&A to sales. So over here I did on the bottom. You can see it over here. I added on here another ratio, which is sales to SG&A and sales to labor. So basically what we're doing in this ratio is for every dollar the company has paid for SG&A, they got a return of 1,618% on their sales. So basically for every dollar they're paying to SG&A, they're getting back in sales $16.8. And this number is just getting better almost every single year. This is amazing. And it shows how efficient the company is. So over here was 16,000, 1,600%, 1,700%, 1,800%, and it's just getting better year by year. Until, of course, COVID, which hit everyone very, very hard. Over here in 2021, it's really 2,200%. So that means for each dollar they're paying SG&A, they're getting back sales of $22. But the sales to labor isn't getting better because, as I said, they're paying their labor pretty much the same thing. It's not changing very much. So over here was 361%. So for every dollar they're paying labor, they're getting back sales of $3.6, 3.7. This isn't going up very much. It's more or less very stable. But the SG&A, which is the corporate and everything that goes with it, that's amazing how much it's becoming more and more efficient. And you can also see the return on SG&A. So this will be the return on SG&A would be the net revenue divided to SG&A. So here is 83%, 66, 120, 98. Slowly but slowly, it's getting better and better. 107, 116. So basically, for each dollar, of course, COVID, everything got ruined. For each dollar that they're paying for SG&A, they're getting back a net revenue of $1.17, $1.16. This is very good. So another thing I wanted to point out is their net margins. So we can see over here that every single year the companies is growing better and better. And the only year that they had a lower revenue than the year before that, we can see over here, is 2004, which it went down from $14 to $13 million. Besides that, every single year, and that's including, over here is another year that they went down a little bit, which is 2008. So only in the financial crisis they went down, they didn't lose money. They just went down by a little bit more than $1 million in net revenue. But every single year, the revenue is growing. Again, this shows how steady, besides COVID, of course, COVID, everything is different. It just shows how steady the company is. It's growing slowly and steadily and very, very nicely. And you could just see these numbers and appreciate it because soon I'll show you the numbers of DRI and you'll see the difference. Another thing is maintenance. So the first few years, they just put in all the capital expenditure together. and that'll be also all the money the company invested in buying new restaurants and also for maintenance. In 2009, they started dividing it into two parts. They did a capital expenditure for new companies, for new locations they're buying, and what they needed for refurbishing and maintenance of what the company's locations that they already have. So it's also a good number. If you have a total revenue of $62 million and all your maintenance is $30 million, that's pretty nice. And it's pretty constant. It's like some years it goes up more, some years it's less. And also in the maintenance, they don't always divide exactly what goes to maintenance, because a lot of their maintenance went on relocating all different locations. So in the later years, they started moving their older locations into new locations which had a bigger prototype, and that also cost them a lot of money. So they also put it into maintenance and didn't put it inside the capital expenditure of buying new places. They just did it inside the relocating new locations. And that isn't actually maintenance. It's more of a capital expenditure that helps the growth. They could have stayed in the older places. So you can see over here also the numbers started going down. That's, you can see over here. So we have here $64 million maintenance, 76, 79. Then it went down because that's when they started to divide it in between the maintenance of relocating places and just maintenance of the current locations that they have. And I was able to take off all the numbers besides the actual maintenance. So as I showed you, the revenue, the net revenue, and here's another thing is their PPE. So on their annual reports, they say that all the PPE, they do it at cost basis. So probably their actual assets are worth much more than what they're stating on their annual reports. A land that was bought 30 years ago is worth much more than a cost basis. That's for sure. So the actual net tangible assets is much more than what's stated on their annual reports. And another nice thing you can see in TXRH report is the debt. They're very conservative with the debt. You can see they take on a lot of debt and then they pay back. Over here they had $64 million and they went out to 13 and 6. Then they take out another amount and they'll stop paying it back. You can see over here $132 million. It went out to 101, 52, 61, 51, and they actually they had here a year which had no debt, zero debt. So we see that the company is very conservative. They don't want to take on too much leverage to continue the growth. And of course, they'll take on new debt and they'll stop paying it back. Of course, COVID, everything got ruined everything. So especially with the casual dining. So I'll just show you here the compound annual growth rate. So the way I do it is like this. If you didn't see my other series, so I like to do. I'll do a 10-year. CAGR and then a 20-year, and then I'll divide it into 15 years, full of segments of 15 years. Over here I did 15 years from 2003 to 2016. From here is 2003 to 2017, and I'll do like full of segments of 15 years, and then I'll do the average of the compound annual growth rate of all these 15 years. So over here we get the 10-year average of the last 10 years. Over here we get the total 20 years from 2000 to 2021, and over here we get the average of full of segments of 15 years. Will just give us more or less a pretty good indication of what's the compound annual growth rate. So in the past 10 years, their top number, the top line was 10%, they were compounding. In the past 20 years, it's 20%, 14.4% or 15%. And the reason for the last 10 years was low because of COVID, which knocked down a lot of things. And that's why this is pretty odd that the compound annual growth rate of the full 20 years is higher than the last 10 years, which usually it's opposite. The longer the company is, usually the compound is going down in the percentage. And the gross margin is actually lower. And over here I did the average gross margin. So this isn't the CAGR, this is just the average of the gross margin for the past 10 years and the past 20 years. So we can see the average of the gross margin is around 35 to 37%. The beginning was 42%, but the average of the past 10 years is 35% and the past 20 years is 37%. And again, over here did the average of the net revenue, the margins. The average of the margins is more or less 5.5%. That's more or less the average of the past 10 and 20 years of their net revenue margins. And the net revenue, the compounding the last 10 years at 13.4%, 13.14%, and 16%. And the average of 15 years is 12%. So basically, we could say this company is compounding at an average of somewhere between the 12 and the 15%. And this number would actually be even higher just because in this 15 years, in 2006 to 2020, it went down because of COVID, and that took down the entire average. If I delete this number, it actually takes up the average a little bit more. But we have a pretty good indication, of how much the company is compounding the net revenue. And if you want to look at cash flows, also, more or less, it's compounding at 12% of cash flows. And here is another thing, total assets, if you're interested you. So they're compounding the total assets at around 12%, 60%. Again, more or less, they're compounding at 11, 12%. And this isn't the true number since they do it at cost basis. If you actually do revaluation of the assets, it'll be much, much higher. And tangible assets also 13%. Total equity, 12% compounding, more or less. Again, the number is changing, 40% in 10 years and 50% in the last 20 years. Shareholders' equity, 7%, 80%. More or less, the company is compounding its net revenue, its assets, its total assets, its total shareholder equity. Everything is around above the 10%. You can say it's pretty clear it's above the 10%. Now, here I'm going to take you to a few ratios. And here's something very interesting. You can see the return on assets, which I do all assets besides liabilities. So it's a very, very big fluctuation going up and down, 10%, 6%, 11%, 9%, it goes down to 7%. And it's really funny. And it's not getting better throughout the years. But if you look at the return on invested capital, it is getting better year by year, more or less. So over here, they started off 14% 2003, 7%, 30%, 10%, 9%, 8%. But if you can see throughout the years, 13, 14, 50%, 60%, 90%. Here's COVID, 21% in 2021. So we can see the net revenue return on invested capital is going up year by year. And also you could do the free cash flow return on invested capital is also getting better year by year. But for some reason, the return on assets is like 10% lower. Really, really funny, the numbers. And you can also see the return on equity. So I do return on equity. I calculate the shareholders' equity. So it's all the equity minus the liabilities. And the net tangible equity, you can see here 7%, 30%, 10%, 10%, 10%, 11%. It's also getting better year by year. The return on equity is getting better and better. 15, 16, 18. Of course, here's COVID, 22%. So it's interesting that the return on invested capital is getting better. The return on equity is getting better. But the return on assets is very, very funny. And I think the reason for that is because basically the restaurant is a cash flow machine. They don't need any once they open up a new location, they don't need any more assets, any more investments. The company, each location is basically generating its own cash flow. So when the company has tons of cash at the end of the year, and we do the return on the company's assets, it includes all the cash. So the higher the assets would be, the lower the return on assets would be. And the company actually doesn't need, over here you can see the current assets, $560 million. That's basically cash and all different kind of current assets. It's a huge amount of money which a company actually doesn't need in the equation of continuing to grow the company. I think that's why the return on assets is so much lower if we compare it to return on equity and return on invested capital. So basically, we conclude this whole thing, and we can see the company is becoming more and more efficient. We can see the SG&A, which is all the corporate expenses that doesn't do with the labor and the rent and the food cost, is getting better year by year constantly. And it shows how efficient the company is. And you can see there was no big ups and downs in the company throughout the years. Even in 2008, 2009, they hardly, just a small little, it went down just a little bit of revenue. They didn't lose money besides COVID. COVID ruined all the casual dining because people couldn't come in to eat. So that's what COVID hit that. But the financial crisis, if we're afraid about a financial crisis coming in the next few years, we can see that a casual dining like Texas Roadhouse is a pretty good position to be in. And if you could take into consideration that Texas Roadhouse is a cheaper casual dining, that'd be even better. Like, let's say people don't lose their jobs, or they're taking off all kind of expenses, and they want to go out, let's say, for once a few weeks or once a month to dine in a casual dining. They would rather probably go to a place like Texas Roadhouse, which is a fun environment, and it's cheaper than, let's say, to a Longhorn, which is more expensive. And would they rather add on a few or $10 or $20 for a whole family for just a little bit higher quality of food? It makes more sense that people would rather go to a cheaper place in times of a recession. And if you're interested in the earnings per share and the book value, so over here they had in the beginning it was 44% earnings per share. They are doing some buybacks. They did Not very significant. You can see 72 million shares, 76 million shares, 76. They're not issuing full of shares that any concern of diluting the owner's position in the company. And you can see here the earnings per share compounded in the last 10 years is 30%, in the last 20 years is 9%. Book value is compounding at 7% and 20% in the last 20 years. So this is more or less the numbers for Texas Roadhouse. Now I want to compare it to DRI. Darden Restaurants, you can see here, here the numbers on millions, sorry. So this is 4.3 billion. It's a much bigger company. 4.3 billion in 2002, and their sales right now in 2022, they finished the fiscal year in May, so they have already the full report for 2022, $9 billion. So it's a much bigger company than Texas Roadhouse, which has total sales for 2021 was $3.4 billion. Yeah, it's triple the size of Texas Roadhouse. Now, Darden Restaurants, they had mainly was Red Lobster and Olive Garden, and they had also Bahama Breeze and Smoky Bones. They sold the Red Lobster after a few years, and they bought Bria, which had Longhorn. So today, if I want to compare something to Texas Roadhouse, will be Olive Garden and Longhorn. Although Olive Garden is an Italian restaurant concept, it's not like a steakhouse like Texas Roadhouse, but Olive Garden is also casual dining. And it belongs to DRI. As you can see here, also a nice company, which is their margins are much better than Texas Roadhouse. You can see 9%, 8%. The margins are much better. And we'll just compare afterwards. I'll show you the comparisons of Texas Roadhouse to Longhorn and to Olive Garden. But what's the story of DRI? DRI was growing at a much faster rate in some ways than Texas Roadhouse. If you could take into consideration, in 2002, DRI was already like 20 years old. And Texas Roadhouse in 2002 was only like 7, 8 years old. And we can see the marketing. This is a huge number. How much money they paid for advertisements each year? 187, 203 million, 208 million. We're comparing it. Texas Roadhouse paid $2 million in 2002, and they're paying $200 million. And you can see the cost of food over here is lower than Texas Roadhouse. So we'll just see how the different concept works over here. You can see, we'll take Texas Roadhouse, compare it to Darden Restaurants, we can see a totally different story. Their cost of food is over here is 32%. In 20 years, they just took it down more and more. You can see 29%, 31%, 20%. It's much lower than Texas Roadhouse. Over here, it's more or less around the 28%. And Texas Roadhouse in the last year was like 33%, 32%. But the labor margins are higher. You can see over here, the labor margins, 32%, 31%, 34%, 32%. And when you have a full concept that's doing lunches and dinners, so your labor is going to be more expensive. But the cost of food is lower, and I assume the reason for that is because they charge more money on their food. So if I'm assuming that Texas Roadhouse and Darden's are paying the same amount for their meat and for their eggs and for the flour and for the sugar, the difference would be in the margins would be that Texas Roadhouse charges a lower price for their food. So DRI is better in the in their cost of food margins, but they're worse in their labor margins. But the marketing, that's a huge story. And you can see an interesting thing that all of a sudden in 2021, they changed course. They took it down from $238 million to $91 to $93 million. So I don't know what happened that all of a sudden they decided to change course. From being 3% of total sales and paying in margins, they took it down to 1% and to less than 1%. That's very nice. So I don't know what's their story. Why did they change it? But that's a fact that they changed it. And we can see here the average of their gross margin is 38 and 37. That's much better than Texas Roadhouse, which we showed before. The average margins of 35 and 37% in the last 10 and 20 years. 35 and 37, and the average net revenue of Texas Roadhouse is 5.5%. In DRI, the average gross margin of 38, more or less 38%, and the average of net margins was 6 to 6.4%. It's much better. So what's the difference between Texas Roadhouse and Darden? The difference is that they bought new concepts. They were growing in a rate that they wanted to buy new companies. They're opening up the whole time new concepts. Today they have a whole array of concepts. They sold Red Lobster, but they have Olive Garden, and they have Longhorn, and they have the Bahama Breeze, and they have Eddie V's, and they have a few more. They have Cheddar and Yard. They have like 6 or 7 concepts. And they bought these new concepts. Some of them they made by themselves, and some of them they bought. And this cost them a big amount of money. And we can see the story over here. What happened to DRI? We can see, I'll go here by the years. If we'll just cover by going by the debt. This is 2008. You can see here, $703 million they had debt, and it went up to $1.8 billion. This is where they bought the beer company, they bought the Longhorn. And the debt really went up from $700 million, the debt went up to $1.8 billion. And over here, they also started doing intangible assets. They started doing the goodwill, what they paid for Longhorn, and another concept. And $970 million went for goodwill and trademarks. And this cost them, they paid a heavy price for the way they grew. And you can see it over here. You can see here the shareholders' equity. So this would be the tangible shareholders' equity. It would be all the tangible assets minus all the liabilities. It was just going down from 1.4 billion, 1.6, then went 1.8, and then you can see over here, it started going down. The retained earnings. Sorry, not the shareholder equity. Retained earnings. Over here, they retained 2.3, 2.6, 2.9, $3 billion, went down to $1,999 million, 996, 548, 560, 658, 807, 144 retained earnings. The company lost and even went to a minus of $26 million in retained earnings in 2022. So this showed you how much money it cost them the way they decided to grow. They decided to grow by buying a new concept, buying a new company. They paid a huge amount of goodwill for this company, and it was a very heavy price. In the end, because I can also show you the locations. In the past 10 years, they have less locations than they had 10 years ago. And the total equity, they did something really funny in their accounting. We can see over here in their assets. So over here they have $5.8 billion in assets, and over here went up to $9.9 billion. Now they did something really funny. They added on in their assets something that they want to sell, like for $3 billion, and they added on in the liabilities from $3.5 to $7 million. I didn't exactly understand what they're doing. I didn't do too much research into it, but the total equity of the company, it went up because they added on a ton of equity and a ton of liabilities, but the shareholders' equity actually didn't become much better. And even now, they're in 2022, they have the shareholders' equity is $2.2 billion, when they were much more even almost 10 years ago. So basically, the company didn't grow in its worth and its value in the past 5-6 years. So I just brought this whole thing to show you a story of two different companies. Texas Roadhouse is looking to grow slow and steady. That's their main issue. They're very reliable. They're very conservative. They're not looking to grow at a huge pace, and they're not looking to take on too much risk. They're not looking to buy new concepts, to making their own new concepts, and they're going with it very slow. And I'll show you the numbers where really we can see the difference between Texas Roadhouse and other companies. So over here, I'll show you what I did over here. So over here, I did the total sales of Texas Roadhouse as the entire business. So this is the entire business, total sales, everything, the company and the royalties. Then we have the net revenue. So this is basically the bottom line and the top line of the annual reports. And then I did total locations of the entire company. That's the company and the franchises. Then I divided the sales. That means the top number divided per location. So this isn't an exact number because the sales per location is actually much higher, because we're taking the total sales from the company and dividing it to all the locations, including the franchises. And if we'll take the total sales of Texas Roadhouse, including the franchises, the number is much higher. But we just want to see the entire business as itself. We don't care exactly how much. We're not trying to figure out over here. I'll do it later on. We're not trying to figure out. We're just looking at the entire business as a total concept. How much is the total sales? How much is the total sales per location? The net revenue per location. We'll just want to see, is the company, when it's growing more and more by itself and by its franchises, is it becoming more and more efficient? Is it becoming more valuable? So we're just looking at the entire segment, the entire company over here. Then I'll divide it in the franchises and the company's locations. Sorry. So we saw the compound annual growth rate of the bottom line and the top line already in the other form. So I'll just do over here the total locations of the company. So in 2003 they had 162 locations, and today in Q3 of 2022 they have 685. 2021 they had 667. This includes Bubba's and Texas Roadhouse and Jaggers. So they're compounding from 2003 to 2012. They were compounding the locations at 9.2%. From 2013 to 2021, it went down to 5%, and in the past 20 years, it's 7%. Now, here's the amazing number: the sales per locations and the net revenue per locations. This shows us how much the company is becoming more efficient. Now, if you actually go into Texas Roadhouse's annual reports, they give you exact numbers of the average volume unit and the average of comparable unit sales. And basically what they do, if you have a new location, sometimes in the beginning there'll be tons of sales because people want to come to the new location, and it's not an exact indication of the location. And sometimes you have a new location which is struggling. It'll take time until it starts growing. So they actually take the comparable stores, stores that opened up for the last 18 months, and they show you a more accurate number of how much each location is earning. Sales, that's the top number, not the net revenue. But because I had to compare Texas Roadhouse to Olive Garden and Longhorn, I had to use the same metric to compare them. I couldn't use one metric over here and one metric over there. So I just basically took the total sales of the company and divided by total locations, and we get a number. And then also the net revenue of the company divided by location, which isn't an accurate number at all, because the net revenue is including the royalties, and it's not an accurate number. We just want to see the company in the past 20 years when it was growing. Is the sales per location growing, and how much is it growing? The net revenue, with the company is becoming bigger and bigger, the net revenue per location is growing or not? So in 2003, they had $1.7 million of sales per location. Per location, right? Total sales. In 2021, it's already $5.1 million per location. So each location went up from $1.7 million sales per location, went up to $5.1 million. And it's compounding from 2003 to 2012. Each location was compounding its growth in the sales of 6%. And for 2013 to 2021, it's up 4%. And from the past 20 years, it's 5.8%. And the net revenue per location is even higher. So again, we're taking the net revenue of the company, dividing it per all the locations. In 2003, it was $91,000 net revenue per location. In 2011, it's 368 net revenue per location, 368,000 net revenue per locations. And this is an accurate number because the net revenue is taking the net revenue of the entire company, including the royalties. If you actually want to take the net revenue per location of the company, that means there's actually no way for us to get this real number. I did something very similar. I'll explain to you what I did. So basically, the net revenue of the company in the annual reports is taking in also the royalties, right? Because the company is telling us how much it got from the company sales and how much it got royalties. And then they take off the taxes and the interest and everything. And the company is paying a lot of employees' money to run the franchises. And the net revenue will be after all the expenses of interest maybe the company took because of the franchises, the SG&A that they're paying because of the franchises. And the net revenue would be including what the taxes that they're paying for the royalties. So we actually don't know exactly how much money the company is net revenue per each company location. There isn't really any way for us to calculate this. But the closest thing that I did was like this. I took the net revenue of the company and I deducted all the royalties the company got. So that means any number that I'm getting was actually high. The bottom line I'm getting now is actually higher, is lower than the true number. Because I'm taking the net revenue. So let's say the net revenue in 2013 was $80 million. I'm deducting from the net revenue the entire royalties that the company got. And I'm not deducting the taxes that they paid for those royalties. Right? I'm deducting the top number of the royalties, and I'm not deducting the taxes that they paid for it. So I take the net revenue, deducting the royalties, and I'm dividing it per company location. So we can see over here in 2003, this is at least the company was earning $48,000 net revenue per company location. This is minimum. The actual number is even higher. And in 2021, their net revenue per company location is $389,000. And this is, again, saying this is minimum. The actual number has to be higher because they're also paying taxes on their royalties. And if you can see this, it's compounding. From 2003 to 2012, the net revenue per company location is compounding at 40%. And from 2013, it went down to 7.8%. Of course, COVID hit very much. But again, in the past 20 years, they're compounding over 10%. The net revenue per location, so besides what the company is growing in more locations, the net revenue per location is also compounding at probably close to 15%. It's lower because as the company is growing older, they're compounding at a lower rate. But it should be somewhere like in between like 12 to 13 to 40%, maybe even more than 50%. They're growing the net revenue per company location. So remember these numbers because afterwards we'll want to compare it to Longhorn and Texas Roadhouse. So over here I took all the company and the franchise financial data. So I took everything together. We'll start taking each one piece by piece. So this is the sales minus royalties. So over here we have the royalties, and over here will be the top line minus the royalties. And over here we have the company locations, and over here I put in the franchise locations. So over here is 86, and over here we're starting to do all the numbers. So company sales per company location. This is the data is on the annual report. The company is telling us in the annual report how much is the company sales, and we know how many locations the company has. So over here, this is very accurate. How much is the sales per company location? So the company sales per company location. So we're taking off all the sales that's coming in, all the royalties that's coming in for franchises and everything else. Only the company locations. So in 2003, their sales per location was $1.7 million. And in 2011, it's $6.76 million. So the company is compounding their sales, the top line in the past, from 2003 to 2012, 8%, and in the past 20 years, it's around 6.8%. And so we have here the company, each location is growing. So we remember this number. Each location, besides the growth of new locations, each location, they're growing their top line, their total sales, at over 6, somewhere like in between 6 to 7 to 8% compounding annually. Again, now royalties. Over here you can see they got 102 per location, per franchise. So we know how much the total royalties were. We know how many franchise locations they had. So we could take the royalties divided by franchise, and this will tell us also the story of the franchises. Are the franchises also growing or not? So the royalties per franchise, $102,000. And in 2011, $245,000. That's how much royalties the company is getting per location. And you can see again, so the company's royalties is a little bit less than the growth of the company's of the royalty. The franchise royalties is a little bit lower than the company's sales. Now, actually, what could be is that the first franchise that they had were paying a low royalty than the new franchises. So maybe they had a different different agreements. So it's very hard to know the actual growth of the franchise's royalties. It's not like the company's sales. There's the same exact number growing the whole time. It's a company sales, the top line divided by location. The royalties could be changing. Maybe they have new franchises paying more royalties, older franchises paying less. So it's a little bit hard to tell. But we can see the company's locations, at least from the data that we have, the company is growing their sales more than the franchises. The company knows how to be more efficient than the franchises. That's another thing we need to know, because we know that Texas Roadhouse is buying back locations from their franchises. And as I heard from the investors relations, they think they can make their franchises even more efficient than the franchises. So over here, I did sales per franchise. So the way I calculated was like this. We know how much royalty they're getting from the franchises. And we know the percentage of the royalties. So we know that the franchises are not paying, the franchisees are not paying more than 4% of the gross sales. Maybe some are paying less, but they're not paying more than 4%. So we know that this number is minimum. It could be even higher, the sales per franchise. If we'll take the 4% of, we'll take the royalty and we'll multiply by 25 times, which would be 4% of the total sales. We'll get the total sales of the franchises and divide per location. So this is the minimum. The actual number was probably high because some franchisees are paying a lower royalty, and the lower the percentage of the royalty, that means the top line was actually the higher. But this is a minimum. So in 2004, the sales per franchise was $2.5 million. And over here again, you see the company sales, $3.3 million. And the sales per franchise in 2021 is 6.1. And the company 6.6. This is very interesting. So although the royalties are compounding at a lower rate, and the sales of the franchises is compounding at a lower rate than the company, but it seems it's hard to know, but that the franchises are actually catching up to the company in their sales. So over here we saw, let me just give you the big numbers, because before you go on to Longhorn and Olive Garden, is the company sales per company location is compounding at 8, somewhere in between probably like 7 to 8%. And the net revenue, this is a great number. The net revenue per location, I mean, as the company is growing larger and larger, the net revenue per location is also compounding somewhere at 7%. Now let's go down to Olive Garden, which belongs to DRI. And Olive Garden is much bigger, and over here all the numbers are millions. So this is $1.9 billion. Olive Garden had 524 company locations in 2003. Today they have 884. How much are they compounding their sales? And so the top line in Olive Garden is growing at 6% in the first 10 years. In the next 10 years, 2%. Again, so COVID hit hard. And in the total past 20 years, 4%. That's much lower than Texas Roadhouse. And over here we have the operating margin. So we don't know how much the net revenue is of each segment. The DRI does not tell us in their annual reports how much is the net revenue per each segment, but they do tell us the operating margins. So we know how much the operating margins is, and we could more or less come to some kind of conclusion how much is the net revenue per location. So from 2014 they started writing in their annual reports the operating margins of Olive Gardens, and the operating margins be the total sales minus labor, food costs, and basic rent, but it's not SG&A and other things. So over here it's $648 million, $700 million. Over here it's already the operating margins of Olive Garden as an entire segment is almost $1 billion in 2022, compounding at less than 5%, at least we know from the last 6 years, more or less. The company locations from 2013 to 2022, it's compounding at less than 1%. Over here, that's where DRI got a big hit. They grew too fast. They bought new concepts, and it cost them a very, very expensive price. They in the beginning they were growing from 2003 to 2012. They're growing at a 4%, compounding 4%, and they got really, really hit harder. They had to sell a few segments, and it was a costly adventure. Let's say it like that. Now over here, sales per location. This is the number I want to compare. Sales per location, $3.7 million sales per location. Today, it's $5.9 million. This is 2022, which is an amazing number. If we go back to 2021, it's already, even after COVID, the numbers didn't go down so much in COVID. $4.15 billion. And they're compounding at 1.4%. Olive Garden, in the last 20 years, their growth, sales per location, right? They hardly have it. There's no franchises over here, so it's all company locations. It's compounding at 1.4%. And how much is Texas Roadhouse compounding sales per location? Over here, you put over here, 5 to 6%. The last, even if you take COVID, in the first year, 6%. The last 20 years, it's almost 6%. If we take COVID out of consideration, we're probably somewhere around 6%. So Olive Garden is compounding sales per location at 1.5%, while Texas Roadhouse is compounding the growth, the efficiency. Each location is compounding at 6% growth. That's an amazing number. And Olive Garden is a very famous restaurant chain. The margins per locations, again, it's 4.2%. So this is something what we would want to try to consider. How much is the average Olive Garden doing in net revenue? So they had sales of $5 billion. Sales per location is $5 million. And their margins per location in the last year was $1.1 million. So this is the operating margin. How much would be the net revenue? Now we saw that DRI, their net profit margins was something like in between 6%. So if we're assuming that this is probably goes for each segment more or less, I mean we can't know exactly, but if we'll take the $5 million, this is sales per location, and we'll do a net revenue of 5%, let's say. So that's somewhere around in the vicinity of the ballpark of around $250,000 net revenue per location. Okay, you can't know the exact number, but if we think 5% from $5 million is $250,000. Again, we don't know the exact number, but it'll be somewhere around there. That's more or less the ballpark of $250,000 to $300,000. How much by our calculations was Texas Roadhouse net revenue per location? We said it was a minimum, and this we know for sure. It's a minimum of $389,000 net revenue per location. How do we know that? Because we know the net revenue, and I deducted from the net revenue the entire royalties, and that is more than the actual net revenue because we didn't take off taxes that they paid for the royalties, and we didn't take off all different expenses that they paid because of their franchises. But even for sure, that net revenue per location is $389,000. So it's probably around $400,000 more or less. $400,000. It's probably more than $400,000 because if you take just the taxes from royalties, they got $20 million of royalties. If it's paying 20% taxes, let's say that's $4 million, right? Divided to all the locations, they're probably getting a minimum of $400,000 net revenue per locations. Olive Garden, on the other hand, we don't know the exact number, but it should be somewhere around $250,000. We can't know the exact number, but that's more or less the ballpark. That just shows you how efficient Texas Roadhouse is. That net revenue per location is way higher than Olive Garden. Now let's take Longhorn. Longhorn is exactly like Texas Roadhouse. We can more or less say from all my research I did on the internet, it seems that Longhorn maybe it has a better steaks. I don't know if it actually has better steaks than Texas Roadhouse, or maybe just because it's more like a fine dining in a fancier place. Like if you want to take out someone to a date or go to a business meeting, you'll probably take them to Longhorn and not to Texas Roadhouse, which is more of a family friendly. It's full of noise and music and it's loud. So I don't know. Longhorn maybe has a more of a psychological feeling on someone that's more expensive and a better steak. I don't know, but you can see it's more or less in the same. From all the reviews that I saw, all the comments that I read, it seems like more or less they're in the same ballpark, very close to each other. Longhorn is more expensive, but probably their food is probably more or less on the same level. So DRI bought Rear, which also had one of the companies that Rear had was Longhorn. They bought another concept together with Longhorn. So in 200, this is the millions. So in 2008, they had $575 million in sales. In 2022, $2.3 billion. So it's still, you can see the company's location is 546. They have a few franchises in Puerto Rico. I think it's like 4 or 5 franchises of Longhorn in Puerto Rico. But mainly all locations are company locations. So they have 546 locations. That's more or less very similar to Texas Roadhouse, which their company location is also somewhere like a 550, 590. And you can see the difference in sales. $2.3 billion in sales for 546 locations. And let's go back to Texas Roadhouse. Their total sales is $3.4 billion in locations. So this is also this is the franchise locations, but $3.4 billion in 2021. Company locations again is 566 in 2021. 566, $3+ billion. And Longhorn, on the other hand, sales in 2022, which is a much better year, it's a full year, $2.3 billion, 546. We just see how much more Texas Roadhouse is selling than Longhorn. And you can take into consideration Texas Roadhouse does mainly dinners, and only some of the locations also have lunch in a few days of the week. And Longhorn does also lunch. That's what I understood. And you can see how much more sales is coming in from Texas Roadhouse than in Longhorn. And again, that's what we see. Although the food cost in Texas Roadhouse is more expensive in the margins than in DRI, but because they have such a higher volume, all the overhead, the labor is lower, the SG&A is lower, the rent is lower, everything goes lower the second you have such a high volume of sales. Again, sales per location. So I'll just do also the compound annual growth rate. So we have in 2008, 2012, that's when they bought the company, so it's 40%, so it's not exactly because it's only a few years. 2013, 2022 is 7%, and the whole 14 years from 2008 to 2022, 8%. So Longhorn seems it's doing better than Olive Garden. It's a newer company also. It's not like Olive Garden is like 40 something years old, I think. And the operating margin is also a little bit better. Company locations, okay, it's less than Texas Roadhouse. They're compounding at a lower rate than Texas Roadhouse, but better than Olive Garden, right? This is 4. In the past 14 years, it's 4%. Although in the past 10 years, it's only 2%. And Texas Roadhouse, they were compounding their locations at 12 and 9% in the past 20 years. So they're growing much more than Longhorn. Okay, sales per location. Again, you can see the difference. Sales per location, 4% compounding. And margin per location is also 6%. So again, let's try to make how much money the company, each Longhorn location is earning. So again, we can't know the exact number. We just know the top line. That's what the company tells us in the annual reports, the top line per location. We know the top line divided by locations, and we know the net margins, and we could divide it by location. So the top line is $4.3 million is the average sales of location of a Longhorn, and their operating margins is around $766,000. If we'll take $4.3 million divided by a net revenue of, let's say, 5%, we don't know exact number. That should be somewhere around $220,000 net revenue per location. Again, that's around half of Texas Roadhouse. That means the average Texas Roadhouse is earning probably close to double than the average Longhorn location net revenue. And over here we have the whole DRI as a whole company, all the concepts all together, and we can see over here how costly it was that they bought new concept. They're growing too much. You can see the total locations. And from 2003 2012 they're compounding 4%. From 2013 2022 they were minus. And in the past 20 years they're compounding the locations at 1.9%. That's what happened because they're growing too fast. They bought new concepts. They had to sell Red Lobster. They had all the new locations. They're closing locations. In the last 10 years they actually have less locations than before that. They have in 2022 1,867 locations. In 2002 they had 2013 they had 2,138 locations. Sorry, I have a little bit of a cold. Sales per location. This is in millions, $3.6 billion. And in 2022, it's $5.1 billion. Again, look at the compounding. It's the whole DRI, all the concepts together. It's Longhorn, Olive Garden. This is including Red Lobster then, but now they don't have Red Lobster. You can take in the Eddie V's and the cheddar and the yards and all the different Bahama Breeze and all the different concepts. From 2003 to 2012, the sales per location was compounding less than 1%. And from 2013 to 2022, which is doing much better, 6%. In the last 20 years, they're compounding the sales per location at 1.7%. That doesn't even come close to Texas Roadhouse. Net revenue per locations, that's a little better. The first 10 years, 2.7%. The next 10 years, 6.6%. The average of the last 20 years, 5.2% is the compounding, the net revenue per locations. So this is DRI as a whole. The compounding net revenue per locations is 5.2%. They don't have a lot of franchises, so it's many company locations. How much is Texas Roadhouse? Compounding in the last 20 years. Net revenue per locations, 7.6%. In the last 20 years. The net revenue per location, 7.1, 7.5, 7.6. They're pretty steady at over 7% compounding. This is including COVID. They're compounding at 7.6% in the last 10 and 20 years. DRI, somewhere, only the last year, which they do much better, was 5-6%. It's much lower. Now, I also want to compare Chipotle. Now, the reason I brought up Chipotle, and I'm also soon going to show you Wingstop, is because it's a totally two different tales of two different stories. Chipotle is a fast food, so we can't compare it to casual dining. It's a totally different concept. What's special about Chipotle? Chipotle, their moat is that they have safe food. They don't have any MSG, and they have only good meat and good avocados. Don't ask me what. And once they broke off from McDonald's, so going back to 2003, they're compounding at an amazing rate. I mean, they put in Texas Roadhouse and DRI in the small packets. In the first 10 years, their sales was compounding at 25%. And in the total in the last 20 years, 18%. That's amazing. And the net revenue is even better. In the last 20 years, they're compounding at 30%. So this isn't an exact number because the first years after they broke off from McDonald's, they had a few bad years. You can see it went up from -7, $6 million, $37 million. So the compounding probably at a lower level than 30% in the last 30 years. When you start off the first number very, very low, then automatically the compounding is a much, much higher rate. And it's not an accurate number. But you can see in the last 10 years, the compounding only at 8%. Still, it's much better than Texas Roadhouse. Not much better. It's like a percentage, 2 percentages higher than net revenue. But this is a very interesting question. What's a better moat, Chipotle or Texas Roadhouse? And that's the reason mainly why I brought up Chipotle. Chipotle has a very, very unique moat in that they have safe food. Though they're fast food, they have a huge brand recognition. They already have over 3,000 locations all over the world. They say they have the safest food, and although they had a crazy story that they had full of illnesses breaking out in a few locations, and they had a few very, very, very bad years, but still they got back the recognition that they're still safe and everything. Over here, there's a story. There's a story a few years ago about they had some brown avocados. Don't ask me what. So in some way, you could say that Chipotle has a more unique moat than Texas Roadhouse. What's Texas Roadhouse's moat? That they have a fun environment and that they have dancing and birthdays and peanuts. Okay, what's special about that? Chipotle, you can say, is very special. They have safe food. In my opinion, okay, this is my opinion. I have no idea if it's right or wrong. I actually think the Texas Roadhouse's moat is better than Chipotle's moat. And the reason for that is, I'll get in the next part, is the story behind Texas Roadhouse. But Chipotle, their moat, besides that it could be easily copied by someone else, what's stopping someone else from opening up a fast food chain and saying they do only safe food? So they're doing safe avocado, so they'll do safe something else. Who cares? It's just about, I'm not saying it's easy. It can be done easily, but it's not something that can be done. On the other hand, Texas Roadhouse has brand recognition for 30 years. That, entire generation of kids grew up in Texas Roadhouse, and that they love the environment. They love the family dinners in Texas Roadhouse. I think that's something that's much, much harder to copy. And I think Texas Roadhouse's moat is just growing and growing more and more and more. Another thing I have found with Chipotle's moat is that their moat is also their problem. Every time there'll be some illness breakout in their chain restaurants, automatically everyone's saying, wait, what's going on? Are they really doing safe or not? And another thing is, I don't know how Chipotle is going to continue to grow at such a rate and get all the special meats that they have and all the special avocados. I mean, could they come to a place of like McDonald's that have 40,000 locations worldwide, and they still have enough avocados for all the safe avocados all over the world? Sorry. I don't know. Maybe yes, maybe not. But I think Chipotle's moat is, although it's unique, it's more breakable. That's what I feel. Maybe I'm wrong on that. I don't know. But let's finish it. Sales per location. So this is a fast food, so food is much lower. $2 million per location, as in Texas Roadhouse, it's $6 million. Oh, sorry. This is Q3, so this is only 3/4 of the year. In 2021, $2.5 million per location. Again, Texas Roadhouse is much higher. And we can see the past years, they had a few problems. That's because of all the stories that they had in the past few years. But another interesting thing is that even Chipotle, which is fast food, because they're fast food and it's not casual dining, the people coming to dinner, you can see that COVID hardly hit them. The casual dining, where people come in to sit down, they couldn't do it in COVID. They had to sell out and do orders. But a fast food, they could do deliveries and all the things. It was much easier for them. COVID hardly hit them. You can see 2018, 1.9 sales per location, 2.1. Same thing, the sales hardly went down in COVID. 5.5, 5.9. You hardly even see in these numbers that there was any pandemic. But in Olive Garden and in Texas Roadhouse and in Longhorn, we really could see the numbers going down in COVID. On the other hand, and this is something that I can't know because Chipotle was growing so much, did the financial crisis hit them more than other companies? I don't know. You don't see over here in the numbers in 2007, 2008, 2009. We don't see as if there was any financial crisis. The numbers are growing amazingly. And in their net revenue, also $70 million in 2007, 78, 2008, 126 in 2009, and this isn't coming from royalties. The company they stopped all their franchises. I think somewhere in 2008 or something. They stopped all the franchises. So we don't see that the Chipotle was hit by a financial crisis. We don't see also in Texas Roadhouse. And COVID, that's where the fast food is better than the casual dining. The COVID hit the fast food much less than the casual dinings. Okay. Net revenue per location again. So this is $220,000 per location, and that's actually pretty nice. I mean, Texas Roadhouse is doing around $400,000 per location net revenue, but comparing it to how it's called to Texas to Longhorn, which is probably around $220,000 net revenue per location, and $2.5 million in sales. So Chipotle as a fast food is doing a net revenue per location probably the same exact thing like Texas Roadhouse as Longhorn. Okay, so I bought Chipotle and now I want to bring up exactly the opposite story, which is Wingstop. Wingstop is exactly the opposite of Chipotle. Wingstop is mainly franchises. 98% of the locations are franchises. And also, I bought this company as a huge grower. And it's just a totally different story. We can see the total sales. So it's all the company, but they restructured, have all the numbers from 2013. $58 million total sales and 282 in 2021. This is Q3 of 2022. They're compounding from 2013 and 19%. 2015 and 2021, it's 20%. Net revenue, they're compounding at 21% in the past 9 years. And their margins are actually pretty high. Their margins, the net revenue margins, are much higher than the rest of the companies. But the problem is that this number isn't telling us a true story because most of their income is coming from royalties and not from company locations. I think Wingstop is a big legal Ponzi scheme. It's about to bust. I'm not saying for sure, but this could definitely be a legal Ponzi scheme. I don't mean it in a bad way. Just saying, I'll show it to you soon. The company's locations are growing an astounding amount, and the net revenue per locations is, we could do a pretty easy way to figure this out, because most of the company's revenue is coming in from royalties, and we know how much percentage of royalties the company is taking. So we could take the royalties, and we could see how much money the company is earning per location, the net revenue per location. So in 2015, it was $12,000 per location. $12,000 per location. That's the net revenue the company is earning per location, and $25,000. It did grow, it doubled in a few years, but is this sustainable? I don't know. I'm not sure at all. And let me show you why. So this is a crazy thing in my opinion. How much royalties is Wingstop taking from their franchisees? In 2013, they have two different kinds of royalties. They have ad fees and they have royalties. So each location is paying 5% of gross sales. This was 2013. 5% gross sales went to royalties to the main company. Besides that, another 2% went to ads. So they opened up a fund. All franchises have to pay 2% of the gross sales to the company, and they use this money to advertise for the entire company. So in 2013, each franchisee was paying 7% of gross sales to the company, and they took it up each year more and more. And I think they're killing their franchisees. They took it up to 6% in 2014, and this was still 2%. So now they're paying 8%, and then they took it up, the ad fees, to 3%. 2017 took it up to 3 and 6, and now they're paying every 9% of gross sales. Then they took it up 2019 to 10%, 4% to ad fees, and 6% of royalties. And in 2022, they took it up even more. 5% of gross sales went to ads, and 6%. So each franchisee is paying 11% of his gross sales to the company. It went up from 7% to 11% from 2013 to 2022. In 9 years, they took it up in a huge amount. I think they're killing their franchisees. I don't know. I don't know, but this doesn't look sustainable to me. Maybe I'm wrong. I don't know. I have no idea. But I'm just taking this Wingstop is a totally different story. We have a huge, fast-growing restaurant chain. It's fast food, and all their income is exactly the opposite of Chipotle. Chipotle stopped doing all the franchise fuel a long time ago. All the company is all the revenue is actually the company's revenue. We know how the company is working. Wingstop is growing at a crazy amount, compounding at a crazy amount, because the whole time opening up new locations, and they're taking tons of royalties from their franchisees, and that's why they're growing at a huge amount. If you actually see the net revenue per location, it's nothing. The company's earning $25,000 per location. It's a joke. I don't know. I don't know how sustainable that it is, but we could see is the royalties per franchise, and this is showing us that it is sustainable. Because we're taking the total royalties the company is getting and dividing it into the per franchise. So they're getting $57,000 in 2015, and now they're getting $125,000. And in Q3, 105 and 3/4 of a year, it's $105,000. It's even more. So the numbers seems it is sustainable, but I don't know. It could be that you have out of the 1,856 franchises, and maybe you have 300 of them that are very, very successful. They're paying a lot of money to the company, and the last new 500 in the last 3 years, more or less. In 2019 they had 1,300. In 2022 they have 1,800. That's 500 new locations in 3 years. Maybe half all those locations are hardly getting by. I don't know. So let's sum this whole thing up. We saw Chipotle, which is an amazing company growing at a very fast rate. It's fast food, and we can see it's much, much better than Texas Roadhouse. We can see the net revenue per locations is way lower. It's like $200,000 in net revenue per locations, and Texas Roadhouse is probably like something like $400,000. And Chipotle, each location is something around $2.5 million. It costs to open a new location. Texas Roadhouse is somewhere like over $6 million. So you're investing double the amount of money, but each year you're getting a much better return. And the net revenue per location in Chipotle is also going much, very, very nice. But actually, in the past 10 years, it didn't grow. You can see over here, in 2012, the net revenue per location for Chipotle was $198,000. And in 2020, it's $220,000. So in 2014, it was $250,000. The net revenue per location hardly grew. In Texas Roadhouse, we see each year the net revenue is growing more and more and more. The company is becoming more efficient and more efficient and more efficient. So again, I'm not saying Texas Roadhouse is a better investment than Chipotle. I'm just showing you how good and efficient Texas Roadhouse is. They're growing slowly, very, very, very good, very, very steady, and very, very nice. And they're much better than Olive Garden and Longhorn. That's out of the question. They're much more efficient. They're growing at a much steadier pace, at a much higher pace. And it's out of the question that as a business, Texas Roadhouse is better than Olive Garden and Longhorn. In the next segment, we're going to go on to explain the story of Texas Roadhouse, what's unique about them, what's special about them, their history, and their moat, the competitive advantage, their brand recognition, a lot of things we'll get into in the next video of this series. Thank you very much, and I hope you enjoyed this video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.